Hi everyone, welcome to today's webinar on bolstering your balance sheet. We expect this webinar will run for about 30 minutes with some time at the end for question and answers. My colleague Melody and I are co-presenting this webinar today, and we'd like to briefly introduce ourselves. I'm Jonathan Wild, and I'm a Senior Manager and Chartered Accountant in our advisory team. I have 10 years experience working as an accountant, with most of that time spent in professional services.
Hi guys, I'm Melody and I'm an accountant in our advisory team too. I came to accounting in BDO after 10 years experience as a personal trainer in New Zealand and overseas. I really enjoy working with people and seeing them achieve their goals, albeit their goals now tending to be finance rather than fitness focused.
And Melody, just to quickly refer to that disclaimer at the bottom of the page there. As a reminder, the information in this webinar is intended for educational purposes and is of a general nature only. It does not constitute legal or professional advice specific to your personal particular circumstances. We recommend contacting us or other suitable professionals for advice specific to your circumstances. So just before we get started, just a little bit of webinar housekeeping. This is a Microsoft Teams live webinar, so all attendees will be on mute for the duration. We have allowed time for Q&A at the end of the presentation, and we welcome all of your questions. So just to ask a question, select the chat icon, select ask a question, and the question box will appear. We'll do our very best to answer all of your questions, but just in case we don't, please leave your name and your contact details and we'll come back to you. Your questions are only visible to us, so please don't be shy. Now let's get into it. So let's consider our thought of the day. The secret of change is to focus all of your energy, not fighting the old, but building the new. Today's session is about building a better balance sheet, which can initially seem quite technical and a bit daunting, but stay tuned and you'll get a clearer on the power and opportunity that lies within. Here's what we're going to cover in this session. We'll talk about the balance sheet, the story it tells us about our business, and discuss some practical and proven strategies for a stronger balance sheet. We'll also cover your 4 most important areas of focus, ways to maximize business value, and then some best practice tips, as well as your next steps and how we can help. Of course, followed by the question and answer. So get your questions in at any time, and we'll answer these at the end. So often, we see business owners and consultants focusing all of their energy on the profit and loss statement, looking at ways to drive up revenue and drive down costs. While that is really important, unless there's also a focus on the balance sheet, profitable businesses can and they do go broke. For example, if you drive up sales, but you don't have a good system for invoicing your clients or collecting the money they owe, then your business can run out of cash. Likewise, a growing business may overinvest in stock, and then in a downturn, like some are experiencing now, they find it difficult to move that stock and convert it back into cash. So cash is often described as the oxygen for your business. There are many ways to increase cash flow, which we will cover shortly. The balance sheet is where your cash is measured. There are some useful calculations that can be done to show how much cash can be created by influencing other numbers on your balance sheet, such as debtors, stock, and work in progress. Just as your banker will look at your balance sheet to see if your business is solvent, so should you. Trading while insolvent is not only extremely stressful, as you'll find it very difficult to pay your bills, but it also potentially puts you at personal risk with creditors, or the tax department, or financiers. We'll show you a test at a glance to see if your business is solvent. In a downturn, it's important to make sure that you're not drawing too much out of the business for personal spending. So your tax bills can generally lag behind the revenue that you're generating. So you could find yourself in a position where a surprise tax bill can't be paid because you've taken too much money out of your business for your personal spending. A personal budget update is strongly recommended at this time. Having a war chest of of cash is essential in times of economic downturn. If profits are down, or if you're making a loss, a strong balance sheet can see you through until profitability is restored.
Now, we know why we need to focus on the balance sheet. Let's talk about what it actually tells us. Your balance sheet, also known as a statement of financial position, provides a snapshot of your business's financial position at a specific point in time. It measures the net worth of your business, which is your assets less your liabilities. It also shows if your business is solvent, i.e., if your assets are greater than your liabilities. If your liabilities are greater than your assets, then your business is insolvent and urgent attention may be required. You can also compare different periods to determine whether the business's net worth is increasing or decreasing between years and can track the strength of your business. The stronger your balance sheet, the easier it will be for your business to survive a downturn. It also provides a basis to calculate key ratios such as debtor days, inventory days, and working capitals. Let's take a look at an example. For our example today, we'll use an imaginary building company. As we go through it, keep in mind that context is important when looking at your balance sheet. In this webinar, we focused on the negative to demonstrate areas that could be improved. But there could be equally positive reasons for this company's position, especially if there is a business plan in place. Additionally, where your business is in its life cycle, i.e. in the startup phase, growth, or mature, it will also affect how the balance sheet needs to be looked at. The first part of the balance sheet is the equity or owner's interest in the business. You can see here that last year the company made a profit of about $71,500, but this year it made a loss of $45,857. For those of you that are special purpose clients, you'll be used to seeing this section at the bottom of the balance sheet. Total equity is just over $2,000, which means if the company makes a further loss, it will be insolvent. Strategies to improve profitability need to be implemented urgently. We'll build the balance sheet as we go to help you understand the layout. The company has a bank current account, but you'll see shortly that it's also running an overdraft. A current account like this is a great way to build up cash reserves for tax payments and any further downturn in trading results. There's income tax receivable of just over $5,000, which means that too much tax has been paid during the year, so there is a drain on cash flow. The opposite can also happen where there's a surprise tax liability when the financial statements are done at year end, which can put pressure on cash flow as well. Having a regular update of your tax position throughout the year helps ensure you don't pay too much tax or too little. Stock on hand has increased by just under $34,000, which is a further drain on cash flow. Holding too much in stock can put pressure on a business as the stock first has to be sold and then the funds collected from debtors. On the flip side, work in progress has reduced by $47,500, which is good news as the higher amount tied up in unfinished work, the longer your cash is tied up. In this example, work in progress is the value of wages paid on jobs that cannot yet be invoiced to customers. The shareholder advance account is showing as an asset of $66,000. In other words, the shareholders owe almost $66,500 to the company. This isn't good because if the company fails, a liquidator or receiver can demand this money from the shareholders and they won't have the protection of limited liability, will be personally liable. We can also see that the balance owed has increased by $32,500 this year, which indicates that shareholders are taking more cash out of the business than what they're entitled to. Accounts receivable, or debtors, have reduced to $82,500, which has freed up a bit of cash compared to last year. By referring to the trading account, we can calculate that it is taking 48 days to collect debtors. If payment terms are 7 days, there's a significant amount of cash tied up here. There's very little value tied up in fixed or non-current assets. This could be a signal of eroding value as fixed assets have dropped by 23,588. In other words, some fixed assets could be in need of replacement, so there could be a future drain on cash reserves when assets need replacing. Although the total reduction in assets this year is only just under 15,500, we need to remember that one of the assets that has increased is the debt owed by the shareholders to the company. The true asset reduction, therefore, excluding the shareholder advance accounts, is in fact 47,996, which could be of major concern. So those are our assets. Now look at our liabilities. We can see that the Visa account has increased dramatically, which could be a symptom of our poor cash flow. Credit card accounts should be cleared in full each month to avoid high interest costs. If you're unable to pay your credit cards each month, it's important you talk to us about how to restructure your finances to avoid these high interests. The bank overdraft has also increased from 36,734 to 38,236. We need to understand what the overdraft limit is and how close the company is running to this limit throughout the month. Often, the most difficult time of the month for cash is not the last day. For example, it might be the day wages or payroll taxes are paid. So we need to make sure there is a buffer of cash in the overdraft. A useful measure here is to see if the overdraft is reduced to zero at any time during the month. If the overdraft for this company never goes below, say, 20 grand, then that 20,000 is considered to be core debt and should be refinanced to a business loan to reduce interest costs. GST is what we refer to as lumpy expenditure, as it's not generally payable every month. A good strategy to preserve cash flow is to put aside a set amount each month for GST and other taxes as well. We've already talked about using the bank current account for this purpose. If you talk to us, we can help you work out how much you should be setting aside each month for tax payments so that you always have sufficient funds available. Note here that last year the tax payable was 15,747, and if you remember, this year there's a tax refund owing. By having regular updates of your tax position, large fluctuations in tax payable can be avoided, which also helps reduce strain on cash and stress levels. Just a quick note that there's a loan here for a phone. Asset finance interest rates are often much higher than bank finance, so be careful accepting finance deals on things like phones, vehicles, and other equipment needed in your business. Perhaps the biggest indication of cash strain in this business is that trade payables have increased from 72,000 to 111,000 this year. If we refer to the trading accounts cost of sales, we can calculate that it's taking 74 days to pay suppliers on average. Last year, it was taking 47 days. Not having sufficient cash to pay suppliers each month is incredibly stressful, as well as risky. We'll look at how to calculate this soon. We can see here the company refinanced loan 70 with loan 71. In the current climate, refinancing such as this may result in reduced interest costs, but we should also be careful of legal and loan application costs as well. With net assets of only 2,087, the company has no ability to borrow any further funds, or it will fail the second test of solvency, which is to always have assets greater than liabilities. We'll go into this in more detail shortly. So with the reduction of net assets of over 45,000, we need to be thinking about how we can bolster this balance sheet and reduce risk. Let's look at some specific strategies to adopt. In the current climate, some company balance sheets would have taken a hit from a downturn in business or not quite be where you were planning to be. What's important is to focus on what you can control and adopt practical and proven strategies to bolster your balance sheet. There are 4 areas we can focus on for building balance sheet strength. The first one, focus on increasing profitability, which is incredibly important in the current climate. The second, focus on improving cash flow. There are a number of ways to do this, which Johnny will explain shortly. The third, focus on solvency. That is whether your business can pay its debts as they fall due, and whether assets are greater than liabilities. Having real-time, up-to-date information is very important to determine solvency. And lastly, focus on your shareholder advance accounts, as these measure whether you're taking more funds from the business than are owed to you as shareholders. Having a dividend and drawings policy is essential to ensure you don't end up with an overdrawn advance account, as liquidators can chase you personally for the balance owed. Revising your personal budget is also important if you haven't done so already.
So the first of our 4 areas of focus is profitability. The best way to increase your profit is to choose 1 or 2 or maybe more of the 7 ways to grow your business. To increase customer retention, build a plan to delight your clients. Under-promise and over-deliver to them so they refer more customers to you and don't defect to your competition. To generate more leads, focus on your marketing, especially referrals, testimonials, and social media, as these are all relatively cost-effective strategies. To convert more prospects into customers, look at strategies that will increase your proposal or quote acceptance rate. Perhaps some sales training could be in order. To increase your transaction value, implement strategies to encourage customers to spend more with you every time they buy. Perhaps offer options to upsell and pick up on that very well-known concept of offering fries with that. To increase your transaction frequency, look for ways to encourage customers to buy more from you more often. For example, offering loyalty benefits, a reminder service, or simply staying in contact with your customers more so you're always front of mind. To reduce your variable costs, identify strategies to eliminate wastage and rework, and also to consider negotiating better pricing with your suppliers. And finally, to reduce overheads or fixed costs, review these at least annually to ensure you're getting the best deal and that they're still required. For example, if more of your team are working from home, could you downsize your office space to reduce rent? Or could you get a better deal on your utilities by changing providers? It is important to be careful that you're cutting the fat and not the muscle, as some of these overheads could be seen as investments in your business. The second area of focus to bolster your balance sheet after building profitability is to improve cash flow. The cash conversion cycle shows how long it takes to receive payment from your customers after buying stock from your suppliers. In other words, how long your cash is tied up in inventory and accounts receivable. So let's look at an example. So we buy stock from our suppliers on day 0. We then pay for that stock 35 days later. It then takes, on average, 65 days to sell the stock to customers. This means our average stock holding is 65 days. It takes an average of 110 days to receive payment from customers. So our average receivables is 45 days. To calculate our cash conversion cycle, we add our average stock holding and receivable days together, then take away the average payable days. This gives us a cash conversion cycle of 75 days. Do you know what your cash conversion cycle is? Because you might be quite surprised. Ultimately, cash is still king, and you want your cash conversion cycle to be as short as possible. The more cash you have in your business, the stronger it will be as it can weather downturns more easily. Technically, if you increase cash by collecting debtors, your net assets don't improve as your debtors go down and your cash goes up. However, the higher your debtors are, the more risk there is of non-payment. Also, the quicker you convert your debtors and inventory into cash, the stronger your business will be. If you can negotiate better terms for payment of suppliers, you can preserve your cash flow for longer. Care is needed here though, as in the current economic climate, slow payment of suppliers does put a real drag on the economy. What's important here is to come to an agreement with your suppliers. For example, they might agree that you only pay when you've sold the item to your customers. You must also look at how long it takes for your stock or your work in progress to be invoiced. The quicker, the better. Consider whether you need to hold so much stock or if you can issue progress invoices or reduce the number of jobs you have on the go. Make sure you're also keeping an eye on how long it's taking for your debtors to pay you. There are so many things you can do to get paid faster, like updating your terms of trade, automated or repeated invoicing, or simply chasing up your slow payers with a systemized process or a credit manager. So let's look at some examples for our building company. So we can see that inventory is taking 38 days to sell, whereas last year it was only taking 15 days. If we could reduce the days by 9, we'd free up around $13,500 of cash. Work in progress is taking 10 days to invoice, which is much faster than last year, which was 41 days. However, if we implement weekly progress invoicing and reduce this by a further 5 days, we can free up another $7,500 of cash. Out of interest, look at last year, it was taking 41 days to invoice work. In that year, if we reduced days even by 25 days, we would have freed up $38,500 of cash. So debtor days have been pretty consistent between 45 and 48 days. However, if we could reduce them by 18 days, so it only takes 30 days for you to get paid, we'll free up $31,000 of cash. If we add to the cash we could free up by reducing our inventory days, work in progress, and debtor days, would free up over $52,000 of cash, or actually just under $92,000 last year. It's also taking 74 days to pay our suppliers, which just isn't sustainable. We need to reduce this by at least 30 days so the company is staying current on payments owing. This would require $45,000 worth of cash. So, if we take the free cash we created of $52,000, deduct the $45,000 we need to pay our creditors faster, cash flow would still improve by just over $7,000 and well over $45,500 for the year before. The key thing here is that life will be so much less stressful for the owner of the company, not waiting so long to be paid, and also being able to pay their suppliers on time.
So, to recap, our first strategy was to build profitability, and the second to improve cash flow. Now we're on to our third area of focus, to bolster your balance sheet, which is to maintain solvency. As mentioned previously, there are two components of solvency, often referred to as the first and second limb. Firstly, the ability to pay debts as they fall due, which is measured by ensuring that current assets are greater than current liabilities. And the second part of the test is ensuring that total assets are greater than total liabilities, not just current ones. Let's look at our example company again. Here we've taken the current assets and current liabilities sections of the balance sheet to calculate our current ratio. Your current ratio tells you if you're able to pay your debts as they fall due. To calculate the current ratio, we divide total current assets by total current liabilities. We can see that in 2020, our current ratio is 1.31. This means there's $1.31 of current assets for every dollar of current liabilities. Last year, there was $1.55. But we need to adjust out the shareholder advance account because this is not a realistic current asset and that the shareholders are not going to pay this money back within a month or two, or at least it's very unlikely. Now we can see that there is actually only 92 cents of current assets for every dollar of current liabilities, so the company is technically insolvent. To fix this in the long term, we need to go back to our first strategy and increase profitability. But in the short term, the company either needs an injection of cash from the shareholders or part of the bank overdraft needs to be converted to a term loan. I'll talk more about the shareholder advance account shortly. Firstly, let's look at the second part of the solvency test, total assets greater than total liabilities. Our net assets, or total assets less total liabilities, appear to be positive at 2,087. However, if we exclude the overdrawn shareholder advance account, the company is actually insolvent by 64,407. The company needs a short-term cash injection of at least 66,494. Let's just say 70,000. If this is provided by the shareholder, we can eliminate the bank overdraft and the shareholder advance account becomes a liability of just over 3,500. True net assets are now 2,087. Of course, the company still needs the previous strategies to increase profitability and cash flow, but at least the two limbs of the solvency test can now be satisfied. So this brings us to the fourth area of focus, managing shareholder loans. I've already covered the risks associated with overdrawn shareholder advance accounts. The main risk is that if your company gets into financial difficulty and a receiver or liquidator is called in, your personal assets may be at risk as the loan is likely to be called up. A great way to avoid an overdrawn shareholder advance account is to update your personal budget so that you can reduce the amount of drawings you take from your company. Personal budgeting is a rewarding and empowering thing to do, especially in the current economic climate. While we're on the topic of personal budgeting, set a regular weekly or monthly amount that you take from the business and stick to it. Lastly, to protect you in the event the business does get into financial strife, having security for advances you've made to your company ensures that in a liquidation, you stand a higher chance of getting your money back.
So just to quickly recap, we've covered a huge amount of detail here, and some of it was quite technical. The main message from today is that your balance sheet is fundamental in assessing your business strength. There are so many things you can do to bolster your balance sheet, including strategies to build profitability, improve cash flow, maintain solvency, and manage shareholder advance accounts. Our aim is to help you take what you've learned today and implement some positive change in your business. So what are your next steps from here? Doing nothing is not an option. Doing what you have always done is unlikely to give you the same results as you've had in the past. Remember to put the oxygen mask on yourself first. Planning for sustainable improvement starts with you and the leaders in your business. Make a clear plan for the steps you'll take to bolster your balance sheet. Focus on what you can do as opposed to worrying about what is out of your control. And lastly, we are here for you and we want to help. So the information in this educational webinar was general in nature and no substitute for specific tailored advice and support. There are several ways that we can help you more specifically beyond today's webinar. First of all, we can prepare a cash flow forecast to help you plan for cash inflows and outflows. This will help you implement strategies to improve your cash flow, and we also offer a cash flow management coaching service. Or if you'd like help to understand your numbers, we also offer financial awareness coaching. If you're not quite ready to commit to a paid service, we can send you a complimentary balance sheet health check for you to complete to review your balance sheet and identify areas for improvement. We could also catch up for a complimentary meeting to see how we can help you achieve your goals. So during the webinar, we've been monitoring the Q&A function and seeing some really good questions come in. So first question is for Melody. You mentioned that context is important when reviewing your balance sheet. Can you give us some examples?
Sure. Say, if you consider a business that is working really hard on expanding its operations, you might see more debt and payables on the balance sheet, which are obviously liabilities. However, in this case, these items are needed to help the business have the capacity in place for future growth. Alternatively, a seasonal business may have built up a large amount of inventory. Sometimes holding too much stock can be an issue, But if this is just a matter of timing and the inventory is about to be converted into a lot of cash and therefore hopefully profit, then there is a very good reason to be holding that inventory. Here's another question, one for you this time, Johnny. Some of the amounts recorded on my assets in my financial statements don't reflect their true market value. Why is this?
Yep, good question. So it's often due to accounting policies that have to be used when your financial statements are prepared. So probably a good example is inventory or stock, which we seem to have talked about a bit. That's generally measured at the lower of cost or net realisable value. And what we mean by net realisable value is that, say, something becomes aged or obsolete and it's less worth than you paid for it. Usually your stock will be sold for more than you paid for it. So you might have a lot of stock sitting on your balance sheet, and you know it's worth more than what it cost, but for financial reporting purposes, you have to record it at cost. It's also a good reminder that you have to turn your stock into sales and get cash back for it and profits, I think you mentioned. Probably another good example is residential rental property. Most often, those properties are recorded at historical cost in financial statements. I think we all are aware of what's happened in the property market lately and the big increases in the value of a lot of residential properties. So in those financial statements, a lot of properties will be recorded at an amount that's much lower than their true market value. I think, as you mentioned when you were answering the last question, when you're looking at your balance sheet, it is actually really important to understand what the numbers really mean.
Great, thanks, Johnny. I think we might have time for one last question, but if you do have any further questions, feel free to get in touch and we'll try and get back to you as soon as we can. Okay, so Johnny, I haven't applied for the government small business cash flow loan as part of the COVID-19 support plan. Is it still possible to get this?
Yep. My understanding is that applications for that are still open, and they're open until December 2023. There are, of course, eligibility criteria, and there are also terms for the loan that you need to be aware of. We have helped clients, and we're happy to assist clients to work through the application process. Probably just a quick reminder is that is a loan, so it does need to be repaid. So that's a bit different to the wage subsidy and the resurgent support payments, that I think a lot of people are aware of.
Great, thanks, Johnny. All right, before we go, I thought I'd share this quote with you. Business is many things, the least of which is the balance sheet. It is a fluid, ever-changing, living thing, sometimes building to great peaks and sometimes falling to crumbled lumps. Make a simple plan today. Commit to at least 3 actions you will take as a result of today's webinar. Write them down, give each of them an owner and a completion date. And do remember, sometimes simple is best, but if you need our support, we are here for you. Thanks for making the time to attend the webinar. We appreciate that your time is very valuable. Please do complete the brief exit survey following this session so we can continuously improve and get your feedback on what other webinar topics you'd like to see from us. As a little bit of an incentive, everyone who completes the survey goes in the draw to win a $50 prize. We hope we've given you plenty of ideas to ponder and some clear next steps for you and your business. Thanks.
Thanks, everyone.